Hey everybody, and welcome to the video training webinar. My name is John Bowens with Equity Trust Company. And in today's session, we're going to be talking about the 6 real estate investing strategies that our clients are using, but unfortunately many investors just don't know much about. Now, how did I identify these 6 real estate investment strategies? Well, in my travels all throughout the country, in teaching at hundreds of thousands of real estate investors, and teaching hundreds of thousands of real estate investors, I have seen the aha moments. I've seen folks that are at our training programs, their eyes light up when they learn about these strategies. And so I want to share these strategies with the masses here with you today. All right, so a little bit about Equity Trust Company. For those of you who aren't familiar, that are new to our firm, Equity Trust is a self-directed IRA or self-directed custodian. And it's not just IRAs. You'll learn about other types of tax-advantaged investment accounts such as HSAs and CISAs and solo 401ks. And our business here is showing investors how they could potentially create tax-free and tax-deferred profits through investing in real estate notes, and a wide array of other alternative investments. It is important for folks to understand that this video training webinar is for educational purposes only. We don't provide tax, legal, or financial advice. So you're going to hear about client stories in this training webinar. I'm going to show you on the whiteboard how clients at Equity Trust Company are effectively investing in real estate, tax-free and tax-deferred. And that's the way that we share and provide information on how you can go out and practically use what we're talking about. But again, we don't provide tax, legal, or financial advice. We've been in business for over 35 years here at Equity Trust Company, and we have approximately $25 billion in assets under custody and administration. Okay, so let's go ahead and jump into how this program is going to work. I want to make sure that you guys get the most out of today's session. So before I go into the 6 strategies, some of these I'm going to be whiteboarding for you, I have some opportunities for you to get more engaged with Equity Trust. At the very end of the webinar, I'm going to be talking about what your next action steps are going to be. All right, so you're going to learn a lot about how you can invest in real estate and other real estate assets with a self-directed IRA or other tax advantage account. I want to make sure you get the most out of today and you have some really solid action steps to take next. So we're going to talk about that at the very end of the webinar. So let's go ahead and dive into number 1. And this is from a very high level, the understanding that you can self-direct your IRA, 401k funds into a wide array of alternative assets, and you're not just limited to investing in the stock market. See, most investors that have never heard of this concept are only familiar with investing in stocks, bonds, and mutual funds. And they may have an IRA, and it might even be called a self-directed IRA, with another financial institution, but that financial institution likely only allows them to invest in stocks, bonds, and mutual funds. So they can select from a menu, if you will, of different mutual funds or ETFs or stock options, etc. But what they don't have the opportunity to invest in is real estate notes, and all of these other incredible alternative investments. And so that's what we're talking about in this session, is how to take control of your financial future, take control of your retirement account, leveraging your knowledge and expertise, whether that's knowledge and expertise that you have now or knowledge and expertise that you're gaining, and be able to apply it to a tax-deferred and tax-free environment. And when we get to number 2, you're going to learn about compounding interest in the absence of taxation and how powerful that can be. So why are Equity Trust clients, why are investors coming to Equity Trust Company to establish and fund self-directed IRAs? Well, number 1, investors find it as an opportunity to diversify their retirement portfolio. So going back to the stocks, bonds, and mutual funds, some investors don't see stocks, bonds, and mutual funds exclusively as diversification for them. This is all about through your lens, self-directed. And so what they want to do is diversify into real estate. Now, some people have experience in real estate already, and they're making a good rate of return in real estate, and so they say, hey, I want to apply those same returns in my IRA. And if they can make more than what the stock market is making, they oftentimes will move their accounts over and begin investing in real estate. Ultimately, you get to make that determination. And I would ask you now, do you feel you can make more in the stock market, or do you feel you can make more investing in real estate? For those of you that are already active in real estate, maybe look at what's the return on investment that you've been making now in your rentals or your fix and flips or your wholesale deals, and say, hey, can I do that in an IRA, and would I make more than the traditional markets? And if you answer yes to that question, it might make sense for you to establish a self-directed IRA and begin applying your knowledge and expertise to investing in real estate with a self-directed IRA. Okay? So, last but not least, it's important to understand that self-directed IRA is an industry term. So it indicates to you as an investor that you have the ability to self-direct. Self-direct is not a legal term per se. In fact, if you wanted to research this further, you could go to the IRS website, irs.gov, and in the search box you could search real estate IRA FAQ, and you'll get some other foundational information on that real estate can be held in a self-directed IRA. You just have to make sure that you're following the rules and you're doing it the right way. All right, so let's go ahead and jump to the whiteboard and jump into number 2, which is going to be talking about a Roth IRA. All right, so let's jump into aspect number 2 or strategy number 2, all about the Roth IRA. So it's important to start off with what's the difference between a tax-deferred traditional IRA and many 401ks or employer-sponsored plans are tax-deferred, we refer to those as, and the Roth IRA. All right, so the contrast of tax-deferred versus tax-free Roth IRA. So the tax-deferred account, that means when we were putting money into the account, such as a traditional IRA or in many cases a 401k, we get a tax deduction for it. And then it grows tax-deferred. So in each incremental year, we don't pay taxes on any of our gains if we do things properly. It's not until we start taking money out that we have to pay taxes. And the qualified retirement age in the United States is 59 and a half. That's something to write down. 59 and a half, that's the qualified retirement age. So what that means is at 59 and a half, when you start taking money out of a traditional IRA or tax-deferred account, whatever amount you distribute is going to be added to your ordinary income, and then you're going to pay the taxes accordingly. Now, that's not necessarily a bad thing. The theory behind this, back when the federal government created the legislation many, many years ago, was allow Americans to get a tax deduction during their higher income years, defer that to when they retire, and hopefully at that point during their retirement years after 59 and a half, they have a lower tax rate. So as they take distributions, they're paying less in taxes. Now, that does not work for all investors. And so that's why we then move into the Roth IRA. So the Roth IRA, you don't get a deduction when you put the money in. It's after tax, all right? It grows tax-free, and then when you take money out of the Roth IRA after 59 and a half, you pay 0% tax on those distributions, providing that you're following all of the rules and regulations. So what a powerful concept. Let me give you a quick case study or example. I have 2 clients in the St. Louis market. They invest in real estate. This husband and wife, years ago, about 10, 11 years ago, moved over 401k money into a traditional IRA, and then they subsequently converted that into a Roth IRA, getting the taxes out of the way. We have another training program specifically on Roth conversions if you're interested in what this means or what it looks like for you. So this couple moved their money over into a self-directed IRA environment. They got their money into Roth IRAs. They each went out and bought a rental property with each one of their Roth IRAs. So husband and wife, they each own a property in each one of their Roth IRAs. It's cash flowing. They then went on to buy a 3rd rental and a 4th and a 5th and a 6th, so on and so forth. And so now the husband has 7 rentals in his Roth IRA. The wife has 6 rentals in her Roth IRA. And cumulatively, they are generating over $110,000 in net tax-free profits on an annual basis. That's powerful because that $110,000 that's coming in every single year, that $110,000, they pay 0% tax. And they are over the qualified retirement age of 59 and a half, which means theoretically they can distribute that money anytime they want and they pay 0% tax. There's no recapture depreciation on the properties. There's no capital gains tax if they sell the properties. It's in the Roth IRA environment. Now, this couple, when I asked them, what do you plan on doing with the money? They told me that they plan on leaving the Roth IRAs to their grandchildren. Because if they leave the Roth IRA to their grandchildren, it's tax-free to them as well. How powerful is that? I mentioned before legacy planning. That's what I'm talking about when I say legacy planning. who are you going to leave your Roth IRA or your IRAs to in the long run? Okay, so that's just a quick anecdote for you. Let's jump over to the whiteboard here and actually talk about some more of the details or numbers of Roth IRAs versus tax-deferred accounts versus taxable savings. So it's first important to understand that we always bucket our dollars, if you will, into 3 different buckets. Bucket 1 is taxable, and I'm going to show you this in just a moment. Bucket number 2 is tax-deferred, and bucket number 3 is tax-free. That's the Roth IRA. Could also be, though, a covered education savings account or health savings account. But for the purposes of this, we're going to say Roth IRA. So again, in recap, 3 buckets: taxable bucket, tax-deferred bucket, and tax-free Roth bucket. All right? Now, this taxable bucket, you have to understand that when you're going out and investing in real estate, you're going to be subject to paying taxes on your gains. If it's not in a tax-sheltered IRA or other retirement account, then you're going to pay taxes. It could be short-term capital gains tax, like if you buy a property and flip it in less than 12 months, you're going to have short-term capital gains tax, which is going to be your ordinary income tax rate. If you sell a property post 12 months, you're going to have long-term capital gains tax most likely, all right, which is 15%, or for some people it's 20%. All right, and you could potentially have other types of taxes relevant in your taxable bucket. So you got to understand that. We would encourage you to team up with your CPA or accountant. Again, Equity Trust is a passive custodian, but I would encourage you to team up with your CPA or accountant to look at these types of things. All right, so that's the taxable bucket. Tax-deferred bucket, think traditional IRA, think 401k. Most 401ks are all tax-deferred accounts. We put money in, we get a deduction, it grows tax-deferred. When we take it out, we have to pay taxes. And then we have the Roth, which we talked about after tax. We put money in, grows tax-free, we take it out, we don't pay any tax. So these 2 environments, tax-deferred and tax-free, are very, very powerful. And I want to be careful on this training webinar. Roth IRAs can be incredibly powerful, but many folks start with traditional IRAs because that's where their money's at now. They have a 401k, they have a 403b, they have a thrift savings plan, it's tax-deferred, and they're saying, hey, I just want to get a better rate of return, and I believe I can drive that rate of return in a more effective way. And so I would prefer to move that over into a traditional IRA, self-directed with Equity Trust, to take action and start investing in real estate. And that's okay. But then we could start talking about the Roth IRA. And I peppered before a Roth conversion. We have other training on that. So you could even take money from your traditional account and move it into your Roth account. All right. So let me rewind here a little bit and show you what this whole compounding interest in the absence of taxation really means. All right, this is what I call the $16.43 a day plan or model. $16.43 a day. If you put into an account, all right, we're not going to talk about what type of account just yet, but if you put $16.43 into an account every single day for the next 25 years, which would be $6,000 per year. Why am I saying $6,000 per year? Well, it just so happens that if you're under the age of 50, the contribution limit to an IRA, traditional or Roth, is $6,000. So that's why I'm using this figure in this hypothetical example. So I put $6,000 in per year, which equates to $16.43 a day. So I would ask you, can you take $16.43 and put it into an account per day for the next 25 years? That's the question you got to ask yourself. All right, my return on investment that I'm going to plug into my financial calculator here is 12%. So I'm going to say that I'm going to make a 12% return on investment each year for 25 years. Now, I do have to factor into this model my tax rate during my contribution years and my tax rate during my distribution years. My tax rate that I'm plugging in for my contribution years, which is going to be dependent on your situation, but in this hypothetical example, I'm going to say 30%. My tax rate during distributions, I'm going to say 20%. So why the difference here? Well, I'm going to assume that my tax rate is going to be higher in my income-producing years and is going to be lower in my retirement years when I'm beginning to take distributions from these monies. All right? So now when I hit submit, what that's going to populate is this graph here. And by the way, if you want to check these calculators out, you can go to the Equity Trust website. For those of you that are already chatting with us, you can check that website out and these calculators out as well. So if I take this $16.43 per day for 25 years, and it's in a taxable environment, meaning that every year I had to pay taxes on my gains. So this 12% return is going to get taxed every year. In a taxable environment, each year for 15 years, so if I grow this 1643 over 25 years, at the end of that 25 years, if I say, okay, I'm going to distribute monies equally over 15 years, each year in a taxable environment, I'm going to have $70,571. All right, that's the amount I'm going to have because remember, each year as I make returns, I'm going to have to pay a little bit of money in taxes. In a tax-deferred environment, I eliminate every year that 30% tax because I'm saving in a tax-deferred, tax-sheltered environment. So that equates to $117,000 a year. So if you're thinking in your retirement years, okay, I'm going to distribute, let's say, this money out over 15 years in a tax-deferred account, I'll have $117,000 in cash flow every year. Now we move over to the Roth IRA. In a Roth IRA, every year, I'm going to have $146,000, just over $146,000 that I can take out of that plan. So this is the $16.43 a day model that we distribute over 15 years during our retirement, and this ultimately is the money that we can distribute every single year. Now, check out the difference on this, all right? The difference between a Roth and taxable savings. How much is that per year? That's $76,000 per year in savings. So if I look at the contrast between the Roth and the taxable account, I am saving $76,000 per year in taxes. Now, let's take a look. If I broadcast that out over 15 years, that's $1.1 million in savings over 15 years. So folks, this is compounding interest in the absence of taxation, which is incredibly powerful, demonstrated by this example, right? $1.1 million in savings if we take the 1643 and put it in a Roth instead of keeping it in a taxable account, contingent on our 12% return on investment and our effective tax rates each year. All right, so that's the Roth IRA and compounding interest in the absence of taxation. Let's move into real estate partnership transactions. All right, so now we're going to talk about partnering your IRA funds potentially with your non-IRA funds. So this strategy was really birthed out of investors who would say, well, wait a second, I don't have enough money in my IRA to do a 100% outright cash deal, but I have money between my IRA and my non-IRA funds, or my IRA funds and my taxable funds. So going back to our bucket analogy that we talked about before, we got our taxable bucket and we got our tax-free or tax-deferred bucket. We could potentially partner those buckets together. Now we have to make sure that we do it appropriately. So I'm going to show you in a case study or client story how this works. All right. I have an investor by the name of Gary that I've been working with for a number of years now. And Gary set up a Roth IRA about 10 or 11 years ago. He made a contribution of about $5,000 at that time. At that time, that was the maximum amount he could put into his Roth IRA. And then he started doing some wholesale transactions. He did a few other types of transactions that didn't require a whole lot of money in order to build up the balance of his Roth IRA. And so then he got to a point where he found a property, and it was a foreclosure, and the property purchase amount was about $41,000. So he needed $41,000. At this time, he didn't have enough money in his Roth IRA for the $41,000 purchase and $31,000 in rehab. So the total purchase and rehab cost was about $72,000 when he bought this property. But he didn't have the $72,000 in the Roth IRA. However, he had enough money in his Roth IRA and his taxable savings in order to be able to put this transaction together. So this is what he did. When he bought the property for $41,000, he partnered his Roth IRA with his real estate investment LLC. So he has an LLC set up for real estate investments that doesn't involve his IRA. So he does deals directly using his IRA. You're going to see what that looks like. And then for his non-IRA investments, he has an LLC. All right, so he partnered his Roth IRA with his LLC to buy this property for $41,000, which was a foreclosure. He bought it at a sheriff's sale auction, put $31,000 worth of rehab into it, paying contractors to do that, was in it for about $72,000, and then sold it for a profit. All right, so this is how he titled the property. So you're probably asking yourself the question, well, hey, John, if I execute on a purchase contract, how do I list the buyer? Well, this is exactly how Gary listed the buyer on the purchase contract, which then carried over to the HUD-1 settlement statement and the deed to the property during closing. Equity Trust Company Custodian, FBO, for benefit of. Gary's Roth IRA, undivided interest, 75%, and his LLC, undivided interest, 25%. So his Roth IRA and his LLC partnered on the deal, 75-25. Now, very important to pay attention to this. From the $41,000 purchase, everything was split from the Roth IRA, 75%, from the LLC, 25%. So at closing, Gary instructed Equity Trust to direct the funds, 75% of $41,000 to the title company, and then his LLC sent the other wire transfer for the remaining 25%. So both entities coming together separately in partner. This is what's called tenants in common arrangement or tenants in common ownership, all right? Undivided interest, 75 and 25. The $31,000 in rehab, very important. That $31,000 in rehab was split 75-25. So if partnering with yourself personally, because you are what is called a disqualified person, you have to make sure that everything is done proportionately. So in this example, Gary, being that he and his LLC are a disqualified person to his IRA, split all of the expenses, and then you'll see in a minute all the profits, 75-25. All right? So again, he didn't have the full 72, but he was able to partner his IRA with his non-IRA money. Now, when they sold the property, he had approximately $25,000 in profit go directly back into his Roth IRA. That's net profit. And then approximately $8,000 went back to his LLC. All right? So he made in total net profit on the deal, he made 25 plus 8, made about $33,000 on the deal, and it was split 75-25. 75 to his Roth IRA, 25,000 tax-free. We go back to our compounding interest example. That 25,000 hits that tax-free bucket. This 8,000 hits that taxable bucket. So the 8,000 is subject to taxes, but the 25,000 is, of course, not subject to taxation because it's in his Roth IRA. Now, what Gary did next was he went out and used that Roth IRA money, and he was able to then, at that point, have enough money to buy a duplex with his Roth IRA. He bought it for around $68,000 from a foreclosure auction. He put about $20,000 worth of work into it, and it's cash flowing at about $1,800 per month, and that's all tax-free going directly back into his Roth IRA. So for some of you, if you don't have enough money in one of your IRAs, you might want to look at how you can partner your IRA with your non-IRA money. All right, let's move into the next partnership example. All right, so now we're going to talk about partnering your IRA with other family members' IRAs. I call this the orbit effect, all right? The orbit effect. And so what I'm talking about is taking multiple self-directed investment accounts, partnering them together for real estate transactions. In fact, I had a client here at Equity Trust. He partnered up to 10 IRAs and investment accounts. He had his IRAs, his wife's IRAs. He had his children's covered education savings accounts involved in the transaction. He had 10 IRAs and investment accounts all partnered together on one individual transaction. So what I would encourage folks to do, for those of you that are already Equity Trust clients, maybe you have a traditional or Roth, look at how you can start to create an orbit, if you will. All right. And for those of you that have come to our live training programs, our one-day wealth building workshops, you'll see that we have a document that we provide to folks where they could start to create this orbit effect. And so maybe it's a traditional IRA for you, all right, because you're rolling money over into from a 401k into a traditional IRA. And then you have a Roth IRA. All right, maybe you have CISA accounts for your children or your grandchildren. Maybe you have a solo 401k. That's another type of an account. If you want to learn more about some of these other types of accounts, we have an entire YouTube video all about all of these different types of accounts. You can go to YouTube and check that out, subscribe to our YouTube channel, you can get more information on that. So there's this sort of orbit effect, I call, where you start to create different types of accounts, set those accounts up, fund the accounts, and then you could start partnering those accounts together to do deals. All right, so let's jump into an example. Example here is Brian. Brian was our Investor of the Year in 2017. So in 2017, we named Brian the Investor of the Year here at Equity Trust Company. Why? Because he made nearly $130,000 tax-free in just 1 year using 5 self-directed investment accounts, 3 CISA accounts, covered education savings accounts, and then a Roth for himself and a Roth for his wife. Now, I'm not going to show you the second transaction. They did 2 transactions in 1 year to make $130,000. I'm just going to show you the first transaction. So Brian had 3 Coverdell education savings accounts. For those of you who aren't familiar, a Coverdell education savings account is a tax savings account that can grow tax-free through investing in real estate, used for your children or potentially your grandchildren's K through 12 education or college tuition. And you can put in $2,000 per year per child. So think, in addition to your IRAs, you could also put $2,000 in per child or per grandchild, so as long as they qualify. So this again is called a Coverdell education savings account. So Brian in 2017, because he was before the tax filing deadline of April 15th, he was actually able to put $4,000 in for each child. So he got $4,000 into each CISA account for each of his children, $2,000 for tax year 2016 and $2,000 for tax year 2017. And what he did is he found a vacant lot, and he bought the vacant lot for $8,000. Now, this lot was in a appreciating market, and there were a lot of developers or builders that were buying lots and building homes on these lots. So Brian got into the transaction early, bought this vacant lot for $8,000, and how he structured the deal is he partnered each one of these CISA accounts in the deal. So on the contract, it read, just like the last example, Equity Trust Company, Custodian, FBO, child number 1, Coverdell education savings account, undivided interest, and so on and so forth. CISA account number 1 here put $4,000 in for the $8,000 deal. So CISA account number 1 got 50% in the deal. CISA account number 2 put in $2,000 and got 25%. CISA number 3 put in $2,000 and got 25%. All right, so on title, it was Equity Trust Company, Custodian, FBO, CISA account number 1, undivided interest 50%, and Equity Trust Company, Custodian, FBO, CISA account number 2, undivided interest 25%, so on and so forth. So 50, 25, 25. All the CISA accounts partnered together to buy the $8,000 property. Brian then, on behalf of the CISAs, sold the property to a builder for approximately $60,000. Netting about $50,000 in tax-free profit. Okay, $50,000 tax-free. So 50% of the property was owned by CISA 1. So CISA number 1 over here got about $25K in profit. So that account went from $25K to nearly, went from $4K to nearly $30K, right, in just 1 year. CISA account number 2 got about $12,500, and CISA account number 3 got about $12,500. So all 3 CISAs combined netted about a $50,000 profit. So if you look at CISA account number 1 for child number 1, that's nearly $30,000 in tax savings that they have in that account that they can use for that child's college tuition or their K through 12 education. One of the great things about a Coverdell education savings account that you can learn more about in one of our other videos is that a CISA account can be transferred to another child in the family, which means if the oldest child doesn't use all the money, they can transfer it down to the younger children. So a lot of versatility, if you will, in that regard. Now you can plug and play this example. It doesn't have to be 50, 25, 25. You could plug in even more IRAs. You can get creative with this whole orbit concept that we talked about. So what I would challenge folks to do on this call is start thinking about how you can partner based on the types of deals you do. It doesn't mean it has to be land flipping. It could be buying a rental. It could be flipping a house. It could be a storage facility. Whatever your expertise is in, you can partner multiple accounts together. All right, so now what we're going to talk about is we're going to gravitate away from partnering with family members, and we're going to talk about partnering with non-family members. In other words, we're going to talk about partnering with non-disqualified persons. See, we've talked about partnering only with disqualified persons so far, which means everything has to be done proportionately. But guess what? If you're partnering with non-disqualified people, then you could potentially carve up the proportions any way that you agree upon with that third party. So let's jump into that example. All right, so fifth strategy that we're going to talk about here, partnering your IRA funds with non-disqualified persons. We're in the home stretch here. We have this and one more strategy to talk about. So as far as partnering with non-disqualified persons, I mentioned that the proportions can be whatever you decide those proportions to be. And I want to back up for a moment because I know that at this point, based on years and years of experience of teaching hundreds of thousands of investors, that a lot of folks get a little bit caught up and confused on this topic. All right, so we talked about disqualified persons, and we have other training on this. But for all intents and purposes, disqualified persons are individuals within your family that are up and down the family tree. So your parents, your grandparents, your children, your grandchildren. You are a disqualified person to your IRA. Your spouse is a disqualified person to your IRA. And then for all intents and purposes, any business entity like an LLC or corporation or S-Corp that you're operating your real estate business through, that's a disqualified person. So the government tells us that you cannot transact business with disqualified persons. That's the reason why in the last two examples, we've been showing you where although there are disqualified persons involved, everything is done proportionately. And everything has to be done proportionately because otherwise we could create transactions between a disqualified person and an IRA and therefore create what's called a prohibited transaction. And prohibited transactions could ultimately result in your IRA becoming fully distributed January 1 in the year in which that transaction occurs. So you want to be careful about that. So the rule of thumb is if you are partnering with disqualified persons, those family members that I talked about, right? Up and down the family tree, your spouse, yourself, your LLCs, etc. When partnering with those disqualified persons, everything must be done proportionately. I always like to say everybody's got to jump in the pool at the same time and everybody's got to come out of the pool at the same time, all right? That's the best way to understand it. All right, so that's partnering with disqualified persons. Very important that you understand that. Now we move over to partnering with non-disqualified persons. All right, so if I meet a real estate investor at, let's say, a local real estate investor sort of meetup type group, all right? Let's say I meet a real estate investor and we get networking and they're not related to me in any way, shape, or form, and we decide we're going to go out and do a deal together. We're going to do a real estate joint venture together. Well, those proportions don't matter because we're not disqualified persons to one another. All right, so important again to distinguish between when disqualified persons are involved and when disqualified persons are not involved. And this can be incredibly powerful, this concept of a real estate joint venture partnering with non-disqualified persons. And I'm going to go back to, for those of you that think you can't get involved investing in real estate with IRAs because you don't have enough money, there are certainly ways that you can start to strategize and look at how you can do it. So, this joint venture concept, I want to mention, a quick disclaimer. You want to make sure you have a real estate attorney you're working with, so that way they can draft the necessary documentation to create these partnerships properly. All right, so that's going to be rule number one. Get a real estate attorney to be able to help you through this process. All right, so let me give you an example. Let's say that I have a Roth IRA, and I have $6,000 in my Roth IRA. Where did I get $6,000? Well, the contribution limit to a Roth IRA for tax year 2019 is $6,000 when I'm under the age of 50. When I'm 50 and over, I could put $7,000 in. So let's say I set up a brand new Roth IRA, I put $6,000 in it. And I'm an investor, let's assume, that can find deals. All right, I have the ability to find deals and I have the ability to network with other investors that could be a money partner with me. All right, this is a hypothetical example. So I have $6,000 in my Roth IRA, and let's say I find a property, okay, and maybe it's a foreclosure, all right, and I can buy it for, let's say, $40,000. So I buy this property I'm going to buy this property for $40,000, and let's say I need about $10,000 in rehab. So I'm going to be in it for $50,000. And then I believe that I can sell it for around $90,000. And after closing costs, I'm going to expect approximately a $30,000 net profit. All right, so based on this example, I'm looking at a $30,000 net profit. Again, I'm going to sell it for $90,000 after some closing costs, $30,000 in profit. Now, I only have $6,000 in my Roth IRA. And I might look at a deal like this that I find, and I'm going to identify the contractors that are going to do all the work on the property. And if I partner with another individual and I give them the proportionate ownership interest, that might not be commensurate with my efforts in actually finding the deal. So what I might do is find a money partner to bring in the deal. So let's say I have a money partner over here, Jim. Jim is not a disqualified person to me. Let's say that Jim I met at a local real estate investor group. And Jim says, hey, I would love to make a passive investment, and I'd like to be your money partner. So Jim comes in and says, hey, you put in 6 with your Roth. I will put in the remaining $44,000 needed for the deal. All right. We'll buy the property as joint venture partners. We'll rehab it, and then we'll sell it for the profit. And per my agreement with Jim, let's say, we're going to split the profits 50-50. So you might be thinking to yourself right away, well, wait a second, John, 50-50, you were just talking about proportionate. Again, Jim is not a disqualified person. So I'm going to negotiate with Jim, and I'm going to say, Jim, I found the deal. I'm bringing the deal to the plate. I'm finding the contractors. All right, you're bringing your money in, and I'm paying you a return on investment, if you will. So we're going to agree to split the profits 50-50. When we buy the property, there's different ways that you can do this. This is where you want to work with a real estate attorney. Different ways we can do this. When we buy the property, we're entering into a partnership. We'll likely have some sort of joint venture agreement, or it could potentially be an LLC. Again, this is where you'd work with your real estate attorney. This is just the concept. All right? You can share this information with your attorney, as we're talking about in this webinar. That's what we would want you to do. Share it with your attorney so your attorney can help you with this process. So we buy the property, we sell it, we make our profit. At settlement, per the joint venture agreement, 50% of the profits, which is $15,000, go directly back into my Roth IRA. So I now have $15,000 in profit plus my original $6,000 in principal. That's now $21,000 I have in my Roth IRA on just one individual transaction. Jim gets the remaining $15,000 in profit. All right. Who can do the calculation on that, right? Jim invested $44,000 and made $15,000. Is that an attractive return on investment for Jim? Absolutely. So Jim's satisfied. I'm satisfied on our hypothetical transaction here, and I just took my Roth IRA from $6,000 to $21,000. And that profit, because I'm doing it in the IRA, in the Roth IRA, is tax-free. All right? So that's the concept of a joint venture. All right, let's go ahead and move on to our last concept or strategy that every investor needs to understand and know about. Okay, last but not least, we want to talk about putting these concepts to practice. All right, you're probably thinking at this point, all right, how do I do it? How do I get started? What are the first steps? All right, it's really a simple 3-step process that you can write down. Step 1 is open and fund your account. Step 2 is direct your investments. Again, this is a self-directed account. And step number 3 is manage your investments. All right, I'll review that again for those of you that are taking copious notes. Number 1, establish and fund your account. Really important, establish and fund your account. Number 2, direct your investment. And number 3, manage your investment. And I'm going to talk about how you can leverage financial technology in order to do this. So a lot of folks are familiar with online banking, quickly accessing funds. Here at Equity Trust Company, we've created a real estate investment platform, if you will, to make it incredibly easy and efficient for you to be able to access your money in your IRA for an earnest money deposit, close on a property purchase, make a loan secured by real estate. We call this system My Equity, and I want to talk a little bit about it. So back to this 3-step process. Open and fund your account is critical. If you don't have an account open and funded, it's going to be very difficult for you to make offers properly, get a proof of fund statement. It's going to be very difficult for you to process an earnest money deposit. In fact, you may not even be able to get money in time to close on a real estate deal. See, when you open and fund your account, if you're transferring or rolling over funds from another IRA firm or financial institution, it could take 2 to 3 to sometimes upwards of 4 weeks to get the money shifted over. So you want to make sure the account is set up and funded well in advance of making offers on properties. All right, so once your account is set up and funded, and we can help you with that process, you can speak to our agents here at Equity Trust Company, and we can help you through that process. So once your account's set up and funded and you're ready to direct your investment, you're going to log in to your My Equity account online. And let's say, for example, you're going to buy a property for $50,000 and you need a $2,000 earnest money deposit. You can do this on your smartphone device if you want. You log into your account and you say, Equity Trust, I'm buying this property on 123 Main Street. I need an earnest money deposit. You hit click, and essentially the ACH direct deposit is sent out for that transaction, or if you need a check sent out, we can accommodate that as well. So it's a very fast and easy way to be able to process your real estate purchases directly through your Equity Trust Company account online. Now, it's also important to know that the paperwork processing, for the most part, has been taken out of the equation. So there's no scanning and emailing and faxing documents. For the most part, you can do everything online, from e-signature to document upload capability. The My Equity system allows you to quickly and easily manage your self-directed real estate investments. All right, the last thing I want to talk about is managing your properties. So if you have properties that you're buying and holding or fixing and flipping, we have a bill pay system that you could simply log online and say, Equity Trust, I need you to write a check made payable to XYZ contractor and mail it to this address. And maybe you want those checks to be mailed directly to your address, and then you're going to deliver that check to your contractor. The checks are always going to be made payable to your contractors or for taxes, insurance, etc. You always want to make sure that the funds are going from your IRA to those third parties, because you personally can't write a check and then have your IRA reimburse you. So you got to make sure all those monies come from the IRA and are sent directly out. And likewise, all profits from the rental or sale of the property go directly back into the IRA. So again, in recap, all monies are going to be paid for all monies are going to come from the IRA to pay for expenses, and all profits are going to go back to the IRA. And you could leverage the online My Equity tool system in order to be able to accommodate all of these transactions. All right, so with that being said, I hope you guys got a ton out of today's program. I mentioned that I do have some action steps for everyone to take. So if you are interested in establishing and funding an account, don't feel like you have to do everything on your own or try to go online yourself and establish and fund your account. We have agents here at Equity Trust Company. When you reach out to us, they will ultimately take you through the entire process over the phone. So all you have to do is simply either e-sign or sign, send the paperwork back in, and we'll essentially take care of the rest for you. So if you would like us to call you directly, you can schedule a one-on-one consultation with one of our account executives. I would encourage you to email us at webinars@trustetc.com. Again, that's webinars@trustetc.com. And this consultation is not just for establishing and funding your account. If you make the decision to take that next action step and establish and fund your account, we can help you with that process. But this consultation is to talk about the orbit that we talked about. looking at the different types of accounts, what's going to make the most sense, guide you through the process, provide information and education on how this can potentially work for you. Again, we can't be your tax advisor, your CPA, or your attorney, but in a consultative fashion, we can help you through that process. So I'd encourage you to email us at webinars@trustetc.com. And then last but not least, we do have a free guide for everyone to take advantage of. It is our case study guide. So if you like some of the case studies in this training, we have, it's about 9 to 11 additional case studies that you can take advantage of. And we have this all built in one case study guide. So email us at webinars@trustetc.com and we will email directly to you this case study guide that's chock full of very hearty content on how clients are actively investing in real estate with their self-directed IRAs. I hope you guys enjoyed today's training. We look forward to working with you going forward and look forward to seeing you on the next video webinar.